Welcome back to the Deep Dive, where we crack open the reports, distill the critical insights, and, give you the strategic shortcuts you need.
Today is a big one.
It is. We are doing a high-stakes deep dive into the commercial and multifamily real estate landscape for 2026. And this is, it's far beyond just a simple rate forecast.
Oh, absolutely. We are analyzing a profound structural reset. It's defined by trillions of dollars in debt coming due and really an entirely new engine of economic growth.
And we've pulled from some of the biggest reports out there. Deloitte, Cushman & Wakefield, PwC.
That's right. And the consensus is pretty remarkable. The market is finally transitioning away from that nervous sort of resilience that defined 2025.
That survival mode.
Exactly, that survival mode. And it's moving toward what the industry is calling a new equilibrium and even some cautious optimism.
So we're done with the volatility then. What defines this new era for an investor?
Well, I'd say this is the moment for the prepared realist. Our mission here is to map out these huge structural shifts that are creating a really unique, and I mean short-term acquisition window for you.
Okay.
You need to understand three interwoven forces. First, you've got stability in interest rates, finally. Second, the single biggest market driver, which is this massive $1.8 trillion commercial debt maturity crisis.
We'll get into that.
And third, the structural shift in demand that's being driven by AI infrastructure. It's totally reshaping what a valuable asset even looks like.
So let's start with that macroeconomic foundation. For years, it feels like the market's been just crippled by not knowing where rates are going.
Yeah.
That ultra-low environment, the 3% financing we all got used to, that's gone.
It is definitively a historical artifact. We just have to accept that. The stability is the real story for 2026.
Right.
The consensus predicts rates will settle somewhere between, say, 5.5% and 6.5% for most new commercial real estate loans. And that predictability, that's the rocket fuel for transaction volume.
Because you can actually underwrite a deal again.
You can underwrite with confidence. You know the cost of capital isn't going to just swing wildly while you're trying to close.
But for investors who've been on the sidelines, waiting for a return to 4%, how painful is it to accept 6.5% as the new normal?
It's a psychological hurdle for sure, but it just reinforces that classic market wisdom. Date the rate and marry the price.
I like that.
If the acquisition price is right, you lock in the debt today. You don't wait for the perfect rate because the opportunity to buy these underpriced assets might just disappear before that rate ever comes down.
And all this is supported by a surprisingly resilient economy, but one that's being propped up by a very specific source.
It really is. Real GDP growth is projected around 1.7% to 1.9% for 2026. But here's the wild part you mentioned. That growth is supported heavily by AI-driven investment,
Which accounted for over half of all U.S. GDP growth in 2025.
That figure should make every investor just pause for a second. If AI infrastructure is literally driving over 50% of economic growth, it proves we are in a bifurcated economy.
Is that a fragile foundation for the whole economy?
It could be, yes, potentially, if that investment were to suddenly dry up. But as long as this, arms race for computing power continues, the property demand underneath those specific tech assets is just incredibly robust.
And that sets the stage perfectly for the defining event of 2026, this central opportunity that's hidden inside the central risk, the wall of maturities. That number, $1.8 trillion, it just makes my head spin. We have to just sit with that.
It's immense. Approximately $1.8 trillion in commercial loans are scheduled to mature in 2026. Just think about the average owner who took out a loan back in, say, 2019 at 3.9%.
Right.
They're now staring down a refi at 6, maybe 6.5%.
Yep.
That doubles their debt service cost overnight. And at the same time, their net operating income, their NOI, is probably lower.
Squeezed by taxes, insurance.
Exactly. The new higher debt payment just won't be covered by the property's lower NOI. The math fails. And the existing lenders, especially regional banks, are so constrained by regulators they often can't or won't extend the loan.
So it forces a sale.
It forces a liquidation.
Now, within that giant debt wall, one of the reports highlighted a specific weaker segment they called the 1031 exchange tsunami. Can you break that down for us? Why are these owners so motivated to sell?
Sure. A 1031 exchange lets you defer capital gains tax if you roll the proceeds from one property sale into a new one. Back in 2020 and 2021, when the market was peaking, about $100 billion in these deals were done.
Well, what happened?
A lot of investors sold their mature, stable assets and bought new ones, maybe a classy apartment complex, just to avoid the tax bill.
So they were buyers motivated by tax strategy, not because they were expert operators.
Precisely. They were opportunity buyers when money was cheap, but they just don't have the operational finesse to manage in today's high-cost world. They have the capital, but not the expertise to boost the NOI, so now they're facing a forced sale.
And they probably prefer a quiet off-market deal.
They definitely do. They don't want a public distressed listing.
So we have this wave of inexperienced owners who have to sell. That sounds like a ticking clock for investors who are ready.
It is, and that clock is ticking faster because of the national mood. Consumer sentiment has just plunged to near historic lows around 53.3. All that fear keeps the broader capital hesitant.
Creating a window.
A rare 6 to 9 month buying window for contrarian investors to get in there before confidence, and therefore competition, comes roaring back later in 2026.
Okay, since this debt wall is cracking the market open, let's pivot to geography, specifically multifamily. We're seeing this major geographic realignment. Why are the Sun Belt hotspots cooling off while the Midwest is suddenly heating up?
The whole Midwest outperformance thesis is built on two things: affordability and supply discipline. The affordability crisis in places like Miami and Austin is pushing renters into stable, institutional-grade metros.
Like where?
Look at markets like Chicago, Columbus, and Kansas City. Chicago, for example, is projected to approach 5% rent growth in 2026. The reason is simple: limited new inventory and disciplined supply. They didn't overbuild.
So compare that to the Sun Belt caution zone. You mentioned Austin, Nashville. What's the core issue there?
It's purely a supply glut. It's a classic story. These markets had this aggressive post-pandemic development boom, seeing 4 to 5% increases in their entire housing stock hitting the market all at once.
Wow.
And that peak supply is just crushing cash flow. Owners are offering heavy concessions, a month of free rent, moving bonuses, just to fill the units. Rent growth there is looking modest, maybe closer to 3%.
So within multifamily, you've also pointed out two clear winners, regardless of what region they're in.
Right. The first is workforce housing. That's your Class B and C properties. National rents are up something like 25% since 2020, which makes affordable units the undisputed national demand sweet spot.
And the other winner?
Build to rent, or BTR.
Build to rent. So we're talking about single-family homes, but owned by an institution and rented out. Is this a fad, or is this a real structural change in how families live?
It's a huge structural change. The data proves it. BTR is the fastest growing residential segment. It's forecasted to reach almost 7% of all new supply in 2026.
Why are they so popular?
They command a 15% to 20% rent premium over a traditional apartment because they serve families who need a yard and more space, but who just don't want a mortgage at a 6.5% rate. It solves a massive need.
Okay, let's move beyond housing to the broader commercial asset classes. The reports show a radical bifurcation here, defined almost entirely by the digital economy.
Absolutely. If AI is driving half the GDP, then the real estate that supports AI is the ultimate flight to quality. And the high conviction winner, without a doubt, is data centers.
We're talking about that generative AI boom, the projected $7 trillion infrastructure opportunity.
And that number reflects extreme, almost inelastic demand. National vacancy for data centers is below 2%.
Below 2%.
It's a supply crunch so severe, it's like trying to find an open hotel room during the Super Bowl. You have to pre-lease space a year or more in advance. Almost all new supply is claimed before they even break ground.
And the main constraint isn't even capital anymore, is it? It's power.
It's all about power. This is leading to intense competition for power-rich sites and, get this, a pivot toward unconventional energy. We're seeing major players investing in partnerships for small modular reactors, SMR.
Small nuclear reactors.
Yes, advanced nuclear energy, just to guarantee a future power supply. The grid can't keep up. And the best part is, data centers are non-cyclical. They follow the tech funding cycle, not the consumer economy. Great diversifier.
Okay, so winner number 2 is a bit more familiar, but still essential. Industrial and warehouse.
This sector just keeps benefiting from these persistent structural forces: supply chain evolution, last mile distribution, the push for domestic manufacturing. Vacancy has stabilized at a very healthy 4.5%, mainly because new construction has fallen off a cliff.
Less new supply means better pricing power for existing owners.
Exactly. New builds are expected to be about half the pace of the last few years, which really supports strong rent growth for what's already built.
Now for the troubled sibling. Office. It's so easy to just write off the entire sector, but the sources point to a distinct uh, trifurcation of performance.
It's three completely distinct markets. At the very top, you have your Class A and trophy assets. These are actually thriving in key markets because of the flight to quality.
Companies want the best spaces to lure employees back.
Right. They want high amenity, hospitality-driven spaces. And crucially, the construction pipeline for new prime office is at a 25-year low. So the supply of top-tier space is tightening just as demand for it peaks.
And at the opposite end of the spectrum, it's pretty clear. Class C office is a clear avoid.
A total avoid. Remote work is entrenched, vacancies are high, and the cost to upgrade these obsolete buildings is just staggering. They are structurally obsolete as office space.
Which brings us to this huge structural shift happening in our cities, the office to residential conversions. This is that aha moment where you solve two crises at once, the 20% office vacancy and the housing shortage.
Yes, and the unit pipeline for these conversions has tripled since 2022. There are over 70,000 units slated for delivery.
And this is being driven by policy, right?
It's enabled by policy. Cities like New York City with over 8,300 units and Washington, D.C. with over 6,500 are leading the way. And local governments are throwing huge incentives at developers. Boston has a program that offers a 75% property tax abatement for 29 years.
29 years. That's incredible.
Yeah.
But I have to ask about the cost. The reports say it's $300,000 to $500,000 per unit just for the conversion. How do investors even make that work?
That's where the deep operational expertise comes in. The costs are high because of, deep floor plates, limited windows, and totally redoing the guts of the building, the MEP systems.
Right.
The incentives are specifically designed to offset those huge engineering challenges. The only way the model works is if you acquire the office building at a massive discount, often 50% or more below its peak value, and then you stack that discount with the tax abatements.
So to quickly summarize the avoids for the prepared realist, Class A, luxury multifamily in those oversupplied Sunbelt markets.
At least until the supply glut clears in 2027 or 2028.
And a blanket avoid on Class C office?
Yeah.
And general retail, unless it's grocery anchored.
Right. In 2026, the focus has to be on income stability and operational control, not just broad appreciation.
Let's wrap this up with investor strategy. Capital markets are waking up. Deal volume is ticking up. How should investors be structuring their move right now?
Capital agility and selectivity are everything. The early mover advantage is already waning, so you have to be ready to move with conviction. And a major shift in liquidity is coming from private credit.
Not the banks.
No. As traditional banks stay cautious because of that maturity wall, private debt funds have become dominant. They accounted for nearly a quarter of all CRE lending in the U.S. last year.
So if you're that prepared realist listening, how do you actually capture these opportunities from the $1.8 trillion debt wall?
You structure off-market deals, you go direct to owners.
You don't wait for a broker?
No. You have to identify those owners, especially the less sophisticated HUD 31 buyers who need a quiet, fast exit to solve their debt problem. This requires specialized data analytics to pinpoint them, and then you have to build a direct relationship. The moment those assets hit the public market, the deep value is usually gone.
And speaking of data, success now requires leaning heavily into technology.
Yeah.
AI isn't just for data centers anymore. It's a playbook for management.
Absolutely. AI platforms are now necessary tools. They allow for transparent revenue intelligence, scenario modeling, optimizing pricing, especially in something like workforce housing where rents are fluid.
What are the top applications?
The top applications right now are really focused on tenant relationship management, so understanding churn risk and retention and portfolio management for deploying capital.
But the reports also caution that just buying the tech isn't enough. Implementation is tricky.
It isn't easy. About 27% of respondents report major challenges with AI implementation. It's often not the tech itself, but a lack of human adaptation, resistance to change.
You need the human expert to interpret the data.
The technology gives you powerful insights, but you still need an operator with the expertise to turn that raw data into an actionable decision that actually impacts the property's NOI.
So, tying it all back, the ultimate takeaway seems to be that investing is now driven by these demographic and digital inevitabilities. Senior housing, workforce housing, data centers, over just betting on the market cycle.
That's it exactly. The market is structurally reinventing itself. 2026 is less of a cyclical correction and more of a hard, permanent reset. The winners will be those who prioritize stable income, operational excellence, and the agility to capitalize on this debt wave before mainstream capital floods back in.
This has been a truly comprehensive deep dive into the $1.8 trillion question facing real estate. We've gone from macro stability to the Midwest's rise, through the trifurcation of office, and into the raw power of AI infrastructure.
The market is rewarding the smart, data-driven investor who recognizes that the landscape has changed for good, favoring those who can manage operational complexity and, move fast.
So here is the provocative thought we want to leave you with, the challenge to mull over. As the U.S. economy continues to be driven primarily by high-income households and massive AI infrastructure spending, how must the successful real estate investor adapt their strategy to target assets that cater only to the haves like data centers and luxury Class A office space, while simultaneously capturing value from the necessities needed by the have-nots like workforce housing and self-storage? The challenge is navigating a market where economic growth is both highly concentrated and highly fragmented.